have a deal, you really need to figure out the best route that can make the deal work for you and for your investors before you say the deal is not good. Capital stack can actually make your deal profitable, but at the same time, you want to be sure that you are not over leveraged. Hello everyone, good to have us again. And today we're going to just continue with what we did last week. Last week we spoke about capital stack, and also I went on the surface level. So today is more of practical to let you know the implications of capital stack, how these things can directly affect your investors and can affect you as a GP if care is not taken. As much as possible, we are all looking for a way to make the deal work, in the sense that we want to raise little and take more from the lender or from people. So that is the idea. But as you are doing that, you also need to be very careful that you balance off the entire thing so that you as the GP is satisfied, your LP investors are satisfied, the lenders are satisfied, the equity partners are also satisfied. So those are the things you want to achieve in the entire process. So there's going to be some form of balancing to do and all that. Last week we talked about the capital stack in terms of the lender, which is the senior lender, and we also spoke about mezzanine, and we spoke about preferred equity partners, and we also spoke about the common equity. And what we discussed, this is just a summary of what we discussed last week. We discussed that the senior lender, which is the first lender, have the lowest risk because the collateral on it is the property. So for example, if you are foreclosed, they take over the property from you. They just take that. Then for the mezzanine, they put a lien on the management of the property. So that is how they are compensated. So the first person that gets paid is a senior lender. The second is the mezzanine if you took a second mortgage. So a mezzanine is in form of a second position mortgage that bridges the gap between the main loan and the equity. So for example, if you're doing an assumable loan and the assumable loan is about 50% LTV, when I mean 50% LTV, I mean that it's 50% of the purchase amount. So assuming your purchase amount is 16 million. So 50% of that is what your assumable loan is. And that means you have to raise another 50% of the 16 million. In order to breach that 50% of the 16 million, which is about 8 million, you can decide to arrange your capital stack by getting a second position mortgage. So getting a second position loan is the second stage you can go. Let's say, for example, the second position gives you 1.6 million and you still have to raise another 3.4. You can still go ahead and say, okay, I need pref. Maybe I'll take a 10% pref. You can get a pref equity partner to give you 10%. Or you get your common equity. Common equity is your LP partners. You can also get them to raise that money for you and all that. So all these things I just mentioned have implications. And I'm going to show you now through the underwriting. I'm going to use a deal as a case study. The first scenario here is a sample of what an LTV of a 70% will look like, and if you have to raise 30% of this. So what I'm trying to say here is that the deal is 16 million. The lender is going to give me 70%. That means I have to raise 30%, maybe for my LP partners and maybe for my GP partners. We all have to come up with 30%, which is the common equity. So I have a deal that is 70% LTV and I'm raising 2%. So if that is the case, if you are familiar with Michael Blank's SDA, this is the implication of this. The lender is giving me 11.2 million, which is a 70% LTV. And if the lender is giving me that, that means myself and my LP team, we are going to raise about $6.8 million. In doing that, this is the implication of what this deal will look like. The IRR on this deal will be 15%, 0.26, and the average cash on cash will be 6.68%. This is because the leverage here is at 70%, and based on this deal, you're going to only get a 6.6% cash on cash. Let's do another scenario. Scenario 2. Let's say we have a lender giving us 70%. And we have a mezzanine of about 10%. That means we are raising 20% of it. The same deal, the same purchase, everything the same, but the only difference in this case is that I'm taking a mezzanine loan. What would that lead to? What kind of decision would that lead to? Before I go into that, I'm going to give you the implication of this, what the returns will look like in terms of cash flow for you and your GPs. So in whatever you are doing, the most important thing is you are considering your investors first. So in this place, if you look at it, it means that if I take a 70% cash on cash, and if I take a 70% LTV, it means that the cash flow will be 70%. If I have a GP split of 70-30, that means my LP members will have 417,000, and we, the GPs, will have 179,000. Please do not forget this thing. Just look at it, because we're going to run 4 different scenarios, and you're going to see the difference of arranging your capital stack. Going by this, some of you will say this is a bad deal because the average cash on cash is 6%. And some people, I've seen some investors that if the average cash on cash is not, let's say 8% or 7.5, they will not do the deal. But because of capital stack, you can actually make your deal profitable. But at the same time, you want to be sure that you are not over leveraged. That's the most important thing. So if we do a second scenario, let's say we have, like I said, a 70% loan from our senior lender, and we have a 1.6 million as mezzanine, which is a second position mortgage. And like I told you in the last week, I said the mezzanine's interest rate is typically higher than the first mortgage because of the risk. They have slightly higher risk than the senior loan, so they tend to increase their interest rate. So as the scale or as the stack is going up, the interest rate goes up with it. So the interest rate increases as the capital stack increases. So for this one, I am assuming I have about 7.5% that they're giving it to me for 7.5% interest rate and at an IO of 12 months. That means in 12 months, I will not pay the principal. I will only pay the capital and all that. So this will be the difference from the other one. This one, I have a mezzanine. The other one, I do not have a mezzanine. So if I take you back to where the returns is, you'll find out that my average cash on this one is about 6.94%, slightly higher than the previous one. The previous one was 15.21. So it's about 2 point something percent higher than the previous one that does not have a mezzanine. So this one has 17.62% because I'm using mezzanine. That means the internal rate of return has gone up. And if you look at it, my multiple, the other one, I didn't talk about that. The multiples on that one was 1.90%, but this one is about 2.09%. So in a case like this, you have to look at exactly what your investors want. So let's go to what is the implication for you as a GP member. So you as a GP member, it's not still bad. You're still getting good cash flow. Your LPs are still getting good cash flow. You're not over leveraged. Everything is fine. It's just that you need to be sure that your investors are okay with you giving them a 6.94% cash on cash. We have some investors that are particular about cash flow than appreciation. So if you have those kind of investors that want to see 8%, 10% cash on cash, this might not be a good strategy for you. But if you have an investor that likes both appreciation and cash on cash, they do not mind if it's slightly at below 7%, you can do your capital stack in this form. So this is the second scenario. So I'm going to show you a third scenario on the same deal. What will be the implication of that? So in a third scenario, I still have my 70% LTV, which is 11.2 million. I have a mezzanine of, that is a second position mortgage of 1.6 million at 7.5% interest rate. In this case, let's say I decided that I'm going to give my LPs 7% preferred returns. So when you hear those preferred returns, the idea of it is that you are putting them as priority. That is, after you've paid your lender, that is the first position, the second position, the next priority will be anybody that has pref returns. So if you're telling your limited partners that I want to give you pref returns, that means after I've paid off my lenders, my first 2 lenders, you are the next on the capital stack that I should pay. But if you did not tell your investors that you're giving them pref, it means that if you have a deal and you did not make profit on that deal, and that deal is supposed to just be maybe 7% cash on cash, and for some reasons you didn't make money, it means that you didn't make money. So you can as well report to your investors that I didn't make money, so it's zero. There was no profit, so it's zero. But preferred returns is even if you didn't make money in year 1, you can defer it to year 2. That is the waterfall. That means if I don't give it to you in year 1, I can move it to year 2. If I don't get it in year 2, I can move it to year 3. And if at all I do not get it throughout the whole period, I can give it to you at the exit. That means when I'm selling or refinancing, that is after I've paid off the lenders, you'll be the next priority before we start doing the 70-30 GP split. So that is for that. So let me go back to the third scenario. So this third scenario, we have the 70% LTV, we have the mezzanine, promised our investor a 7% preferred returns. So let's see what will be the implication of that. You can see the dynamics have changed significantly. It means that now they're going to get an IRR that is way above the other two scenarios, and their cash on cash here is also going to be way above. So the same deal, the same purchase amount, but the way the capital stack was structured has given me a different returns for my investors. So that means when you have a deal, you really need to figure out the best route that can make the deal work for you and for your investors before you say the deal is not good and all that. So from a deal that was 6.5 average cash on cash has now become 9.04 average cash on cash. And the IRR has also improved. It's about 19.50%. And my multiple on this one is about 2.19x. What does that mean? That means that I'm going to get double plus, more than double the amount I invested. So if your investor, anybody that invested 50,000 is going to get more than double that amount. So it's going to get 100 and something thousand returns after the entire 5 years. I know that. So, but let us see why you should be careful about doing it. It looks very attractive, right? The cash on cash is good and everything. Let's see the implication to you as a GP member. What would that look like? And how would that affect you? So this is the implication of it. It means that you are making money. On this deal, you made a total cash flow of about 529,190. That is, after you've paid your lenders, you've paid everybody, you made this profit. But because you promised your investors, your limited partners, preferred returns, they come next before your GP split. So you are going to give them 7% of what they raise. So for example, if you help your limited partners, your common equities money was 3 million. So you're going to give them in year 1, 7%, because that's what you promised them, 7% of what was raised. So if you collected 50,000 from an investor, 50,000 will have the investor will have 7% in year 1 and have 7% in year 2, year 3, year 4 until the end. That is how you're going to pay that investor. The downside of this is that, for example, during this exercise, something happened to this deal and the tax was increased. Let's say my tax became, let me go back to the scenario tab so that I show you the implication of that. So let's say, for example, my tax increased to 400,000. This would be the implication of that. So initially, I made a profit of 500 and something thousand. Right now, my profit has significantly reduced to 399. You should also remember that there are some expenses that you don't have control over. Yes, you've projected for them and all that. Like what is happening in Florida. Many people that have multifamily there would have projected insurance to be this. But I foresee that in the next 12 months, insurance will double again, which it has happened before, and now it's going to go even higher because there's no competition. Many insurance companies will leave. So if that happens, that means insurance costs will go high. So for someone that has said, my insurance cost is 200, and come year 2, it becomes 350. It means that your cash flow has been affected. And what is the implication of that? It means that if you look at this box, I want you to concentrate on this. My cash flow has reduced because my insurance went up by a significant amount. So based on that, I do not have cash flow to give to my GPs, and I do not have cash flow for my LPs. The only money I have is the preferred equity. So sometimes you hear when people say, do not do preferred equity because it's risky for you as a GP. This is one of the reasons why they tell you to avoid structuring your deal to have preferred equity. So for me, I've looked for better ways in managing preferred equity. Yes, we want to make our deals good for our investors. At the same time, we also are in this not as a non-profit. We're also in this business to make money as GP members. So you're putting your investors first, and at the same time, you're also trying to make it's good for you. What I do with my team is I always encourage them to invest their money. When they're investing their money, they're investing it as a limited partner. So whatever advantage the limited partner has, they're going to have it. For example, if that year the insurance went up, we're not able to make our insurance doubled, our cash flow reduced. Based on that, we don't have any cash flow. Because we as GP also invested as an LP, we might not feel the brunt of it because we'll also take part in this 346,000 preferred returns. We'll be part of it because we also invested as an LP. So this is unique to us. To me, this is how I've decided to navigate or mitigate the risk of that. But if you are different and you see that this is not the way you want to go, you might try to avoid using pref, although it makes the deal more attractive. If you're an LP partner, it's very attractive for you, but as a GP partner, you might end up not making money throughout the entire 5 years. So if you look at this deal, because of one single expenses went up, my entire cash flow has gone.